Hello, friends. If you are a saver or retiree in the UK whose savings have been earning noticeably more interest than they did a few years ago, this video is made for you. Here is the question most people have not thought to ask, but getting the answer wrong carries a real financial consequence. When your savings earn interest, is it your legal obligation to inform HMRC, or does the system handle it automatically on your behalf? Most people in this situation have never needed to think about it before. Now, the rules have always existed. But the conditions that make them relevant to ordinary savers have changed dramatically. The answer is not a simple yes or no. And that is exactly why this is genuinely confusing. By the end of this video, you will know which side of the threshold you fall on, what you are required to do, and 3 concrete steps you can take right now. Before the rules themselves, there is one fact about your savings that most UK savers do not know. We are saving it until we have laid the groundwork, because it lands more clearly once you understand everything that leads to it. Quick context first. This video is made for UK retirees, pensioners, and careful savers who want to understand how HMRC treats interest earned on savings, a topic newly relevant to far more people because of how interest rates have shifted. Everything we share today comes from publicly available official sources, HMRC and the UK government's official website, the Department for Work and Pensions, and citizens' advice. We will name each source as we go. This is educational content only, not personalized financial, tax, or legal advice. And nothing in this video is a promise that you will or will not owe any specific amount of money. Before making any major decision about your savings or tax position, please speak with a qualified tax professional or contact Citizens Advice for free guidance. Right, let us get into what matters. There are 6 things every UK saver with meaningful savings needs to understand about HMRC and savings interest. The reason so many people are confused about this right now is not that they have done anything wrong. The rules around savings tax have always existed, but for most of the past decade, near zero interest rates meant those rules were irrelevant to the vast majority of ordinary savers. When conditions change but rules stay the same, millions of people suddenly face obligations they have never encountered before. Before we begin, a quick question for the comments. Has your monthly pension income changed slightly in the past year without explanation? Drop a yes or no below. Once you have watched this video, you will understand exactly what may have caused it. The first thing is the context that makes everything else make sense. For most of the decade between roughly 2012 and 2022, the Bank of England's base rate sat at or close to zero. Someone with £100,000 in savings during those years might have earned between £100 and £400 in annual interest. The rules existed, but for most ordinary savers, they never applied. Then came the inflation cycle of 2022. The Bank of England raised rates sharply to levels not seen in over a decade, with the base rate peaking at 5.25%. Even now, with rates easing back, they remain far above the near-zero world. Most UK savers spent the previous decade in the same person with £100,000 in a fixed-rate account could now be earning £4,000 or £5,000 in annual interest. Someone with £200,000 put away might earn over £10,000 in savings interest alone. That has pushed millions across thresholds they have never previously crossed, which is why HMRC has been writing to savers who have never received such a letter before. The second thing is an allowance. Many UK savers know nothing about the starting rate for savings. According to the official HMRC guidance, if your total income from wages, pension, and all other non-saving sources falls below £17,570 in a tax year, you may be entitled to an additional tax-free allowance of up to £5,000 on your savings interest, on top of your personal savings allowance. The starting rate reduces once your non-savings income exceeds the personal allowance of £12,570, losing £1 of starting rate for every extra pound above that figure, disappearing entirely at $17,570. This matters for pensioners because the full new state pension for the current year, confirmed by the Department for Work and Pensions, stands at £241.30 per week, approximately £12,548 per year. That is almost exactly equal to the personal allowance. Someone drawing only the full state pension keeps almost the entire £5,000 starting rate. Add a private pension of more than around £5,000, and the starting rate reduces sharply or disappears. Do not assume you qualify. Work out your own non-savings income and compare it to those two HMRC figures before drawing any conclusions. The third thing surprises many people. What happens below the £10,000 threshold? Even there, HMRC may already be collecting tax on your interest without sending any formal demand. Your bank or building society is required to report to HMRC exactly how much interest your accounts earned each tax year. When your savings interest falls below £10,000 but above your personal savings allowance, HMRC typically adjusts your tax code to collect the tax owed, usually through the code applied to your pension payments. The result, you receive slightly less each month, automatically, with no self-assessment required. Many people notice their income has dipped slightly and cannot explain why. Has your pension changed slightly in the last year without explanation? Let us know in the comments. If HMRC overestimates your annual interest, you can contact HMRC directly to have your tax code corrected. The fourth thing is the personal savings allowance. According to HMRC, every basic rate taxpayer receives a personal savings allowance of £1,000 per year. The first £1,000 of savings interest you earn is completely tax-free. If your total income pushes you into the higher rate band, above £50,270 in the current tax year, that allowance halves to £500. If your total income exceeds £125,140, you receive no personal savings allowance at all. For most pensioners on a state pension, plus a modest occupational pension, the basic rate applies. Pause this and write these down. £1,000 for basic rate taxpayers, $500 for higher rate, $0 for additional rate. Those are your personal savings allowances, the starting point for any savings tax calculation. Above those allowances, savings interest is taxed at your marginal rate. 20% for basic rate taxpayers, 40% for higher rate, and 45% for additional rate. Per the current HMRC tax rates, consider Dorothy an illustrative composite, not a real individual, but drawn from circumstances many UK savers have genuinely faced. Dorothy is 71, a former civil servant from the East Midlands. After Bank of England rate rises, she moved approximately £220,000 into fixed-rate bonds at around 5%. In the 2025-26 tax year, her savings interest reached approximately £11,000, just above the £10,000 self-assessment threshold. She had never filed a self-assessment. When a letter arrived from HMRC, she assumed it was a scam and set it aside for weeks. When she finally investigated, she found the letter was genuine. She had missed a registration deadline, and an automatic penalty of £100 had already been applied. Dorothy did nothing financially wrong. She simply did not know that above £10,000 in savings interest, filing a self-assessment is a legal obligation she had to initiate herself. Nobody would do it for her. The fifth thing is what HMRC already knows, and this is the fact we have been building towards since the very start. Your bank has been reporting your savings interest figures to HMRC for years. Every bank and building society in the UK is required to pass those numbers to HMRC at the end of each tax year. HMRC knows how much interest you earned and from which accounts, sometimes before you have worked it out yourself. This is how it contacts savers who never filed a return, comparing bank interest data against income records, acting when numbers suggest tax may be owed, but no return has been filed. HMRC has legal powers to recover unpaid tax directly and actively cross-references banking data with other records. Waiting and hoping the situation resolves itself carries real and avoidable risk. The sixth thing, and the complete answer this video has been building toward, is the ISA. The individual savings account is a protected vehicle where interest is completely invisible to HMRC for tax purposes. Interest earned inside a cash ISA does not count toward the £10,000 self-assessment threshold, does not reduce your personal savings allowance, and does not trigger a tax code adjustment. According to HMRC's ISA guidance, the annual allowance for the current tax year is £20,000. You can shelter up to £20,000 per year, and anything already inside an ISA from previous years remains protected indefinitely. If you have substantial savings in regular accounts and your interest is approaching the thresholds we have covered, moving funds into ISAs over time is the most effective long-term strategy available. Now, closing the loop, we opened at the very start. If your savings interest reaches £10,000 or more in a tax year, you must register for and complete a self-assessment tax return yourself. HMRC will not file one for you. Register through the Government Gateway on the UK government's official website. If your interest is below £10,000 but above your personal savings allowance, HMRC typically collects any tax owed through your tax code. In either case, your bank has already reported your interest. There is no scenario where doing nothing indefinitely is the right approach. 3 steps to take right now. First, find your annual savings interest statement. Your bank issues one at the end of each tax year. Add up the total. Second, compare that figure against the thresholds we covered. Your personal savings allowance, your starting rate if it applies, and the £10,000 self-assessment threshold. Third, if you are at or above £10,000 and have not yet registered, do not wait for a letter. Use the Government Gateway on the UK government's official website. Registering voluntarily and filing on time avoids penalties and shows good faith. Use your ISA allowance every year. Keep your interest statements. And if you are uncertain about your own situation, please speak with a qualified tax professional or contact Citizens Advice, which offers free guidance. Share this with a family member or friend whose savings have been earning more since rates rose. It could save them from a penalty they never saw coming. Our next video covers ISA transfers in detail. Subscribe and hit the notification bell so you never miss it.